Welcome to Learning Unit 3, the Accounting Equation. The title on the screen is The Architecture of Balance. And by the end of this session, you will understand why the word balance is not a metaphor, it is a mathematical certainty. Let us take stock of where we are. In Learning Unit 1, we mapped the environment, what accounting is, who uses it, and the forms a business can take. In Learning Unit 2, we named the pieces: assets, liability, equity, income, and expenses. We can now describe a business at a single moment in time. What we cannot yet do is describe a business in motion. Businesses do not sit still. Guests check in and check out, suppliers deliver, wages are paid, loans are drawn and repaid. Every one of those events changes the picture. And this learning unit is about how. Here is the claim at the center of the session. And I want you to hear it as a claim you can test rather than a rule you must accept. Every single transaction a business enters into, however simple, however complicated, has at least two effects. And those effects always leave the equation in balance. Not usually, not when the bookkeeper is careful, always by construction. That property is what makes accounting self checking, and it is why the system has survived largely unchanged for more than 500 years. We will get there in three movements. First, the equation itself and what it means. Second, transaction analysis, working through the three groups of transactions and watching the dual effect operate. Third, the translation of pluses and minuses into the professional language of debits and credits. Let us begin with the logic underneath the equation. Before we write any formula, I want the reasoning behind it because a formula you have reasoned your way to is one you cannot forget. Start with a question. Where does a business get its money? There are two possible sources. It comes from the owner or it comes from outsiders. There is no third option. Money does not appear in a business from nowhere. Now, the second question: what does the business do with that money? It converts it into asset. Cash sits in the bank, which is itself an asset. Some of it becomes kitchen equipment or shuttle vehicle, a building, a stock of wine. Some of it goes out to customers who owe you and becomes debtors. In every case, the money has been converted into something the business controls. Put those two ideas side by side and look at the two halves of the slide. On one side, where the money went, the things the business owns. On the other side, where the money came from, the founders. And here is the point: there are not two separate lists. There are two descriptions of the same money, looked at from opposite ends. Every rand of asset in a business was put there by somebody, and that somebody is either the owner or an outsider. So the totals cannot differ. What the business owns must exactly equal how it was funded, not approximately, exactly at every moment. If you have ever wondered why accountants make such an issue of things balancing, that is the reason. Balance is not a target. the bookkeeper aims at. It is a logical consequence of the fact that you are counting the same money twice from two directions. If it does not balance, something has been recorded wrongly. And that is exactly what makes the property useful. Now we can write it down. Assets equal owner's equity plus liabilities. A equals OE plus L. The slide calls this the central nervous system of a business, and the description is apt. Everything a business does registers here. Take each term. Asset on the left, what the business owns and controls. In the language of the previous slide, this is where the money went. Owner's equity on the right, what the business owes to the owner. Remember from learning unit 2 that we treat the business as a separate person from its owner. So money the owner put in is money the business owes back. Liabilities also on the right, what the business owes to outsiders, loans, creditors, overdrafts. Both terms on the right are claims against the asset on the left. Equity is the owner's claim. Liabilities are the outsider's claim. Together, they account for every rand of the asset side. Now, compare this to the formula you learned in Learning Unit 2. Asset minus liabilities equals equity. Look carefully because these are the same statement. Move liabilities from one side to the other, and one becomes the other. Learning Unit 2 arranged it to answer the question, what is the business worth to its owner? Learning 3 arranges it to answer the question, where did the asset come from? Same relationship, two useful arrangement. And the line at the bottom of the slide is the one to memorize. Every financial transaction, no matter how complex, triggers a dual effect to ensure this formula never breaks. Dual effect. At least two things change with every transaction, and they change in whatever combination keeps both sides equal. There are only four ways that can happen, and it is worth naming them now. An asset rises and a claim rises with it. An asset falls and a claim falls with it. An asset rises while another falls, or one claim rises while another falls. Every transaction you will ever record takes one of those four shapes. That is what we will spend the middle of this session proving to ourselves. Before we start moving numbers, let us populate the equation with things you can actually picture because abstract letters are hard to reason with. Asset on the left, the slide calls them the engine, and that is the right way to think about them. These are the resources that do the work of earning revenue. The non current ones, the infrastructure, the kitchen and laundry equipment, guest shuttle vehicles, large buildings. The current ones, the short horizon resources, corporate client data, being the tour operators and companies who owe you on account, food and beverage inventory, bank cash. Owner's equity in the middle, the owner's claim. And notice this column is split by direction, which is the detail that matters most on the slide. Items that increase equity capital investment made by the owner, accommodation and venue hire, fees earned, food and beverage sales. Items that decrease it: housekeeping wages, electricity, and private cash drawing from the owner. Stop on that for a moment. Four different kinds of item, all living inside one column. Capital and drawings are transactions with the owner. Income and expenses are transactions with the outside world. But all four ultimately land in owner's equity because all four change what the business is worth to its owner. This is the single most important structural insight in the learning unit, and it is why the equation only needs three terms to capture five elements. Liabilities on the right, the outsider's claim, non-current, mortgage bonds, long-term equipment loans, and for the current liabilities, we have creditors such as your food suppliers, municipal accounts, and bank overdraft. One more observation before we move on. Look at how much of the left column is illiquid: buildings, vehicles, kitchen equipment, and how much of the right column falls due in short term with creditors and municipal accounts and overdraft. A lodge can be entirely solvent on this page and still find itself unable to pay a supplier on Friday. That mismatch between the timing of the two columns is one of the central problems of hospitality management or any management, and the equation is where you first see it. Keep this slide in your mind as we work through the transactions because every scenario that follows moves one item in the left column and one item in the right. Every transaction a hospitality business enters into falls into one of three groups. Learning the groups is worth more than memorizing individual examples because the groups tell you what to look for. Group A: structural shift. The transactions affecting assets and equity or liability only. These build or reduce the foundation of the business. The owner injects capital. The lodge takes out a loan. A vehicle is bought. A creditor is paid. Notice what is absent from that list. Nothing here is trading. No revenue is earned and no operating cost is consumed. The business is being built or reshaped, not run. Group B: profit generators. Here, transactions giving rise to income and expenditures. These are what the slide calls the drivers of daily wealth. A conference is hosted and billed, wages are paid, electricity is consumed. This is the business this is the business actually operating, and this is the group that produces profit or loss. Group C: assets swapping. Transactions involving payment by daters. A client settles an account, and this group has a property that surprises students the first time. It changes nothing on the right hand side of the equation at all. We will see why shortly. Here is how to use this framework when you meet an unfamiliar transaction. Ask yourself, Is the business being built or restructured, or is the business trading? Or again, is one asset simply being exchanged for another? Group A, Group B, Group C. The group tells you which part of the equation to expect to move, and that is the most of the work. One caution about the labels: the groups are a teaching device, not a legal classification, and a single business event can contain elements of more than one. A guest who settles a restaurant bill in cash at the table is 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 earning income and receiving cash at that same moment, which touches group B and group C together. Do not force a transaction into a box. Use the groups to prompt the right questions, then follow the effect wherever they actually go. Let us take them one at a time. Group A: building the business structure. Three scenarios on the screen. And I want you to say the effect out loud with me before I explain it. Scenario one: a capital contribution. Miss Naidu deposits 500,000 Rand into the business. Two things happen. The bank balance rises by 500,000. So assets increase. And the business now owes Miss Naidu 500,000. So capital. And therefore, honest equity increases by the same amount. Plus bank plus capital. Left side 500,000, right side 500,000. Balanced. Scenario 2: securing a loan. The business borrows 200,000 Rand from Medfin. The bank balance rises by 200,000. So assets increase, and the business now owes Medfin, so liabilities increase by 200,000 plus bank plus loan. Again, both sides move up together. Pause on the comparison between those two because it is the sharpest point on the slide. From the bank account's point of view, scenarios 1 and 2 are identical. Money arrives. What differs is who has claim on it. In the first case, the claim belongs to the owner and lands in equity. In the second, it belongs to an outsider and lands in liabilities. Same asset movement, different founder. Scenario 3: buying on credit. The business acquires 250,000 Rand shuttle from GM Motors on account. Vehicles increase by 250,000. So assets rise. Creditors increase by 250,000. So liabilities rise. Plus vehicles plus creditors. No cash has moved at all, and yet the transaction is fully recorded because the vehicle is controlled and the obligation exists. The insight printed on this slide is worth repeating. These transactions build or reduce the business foundation without directly affecting daily profit. Miss Naidu's 500,000 is not income. The loan is not income. Neither has anything to do with how well the load trades. That distinction is exactly what Group B is for. Group B, the daily pursuit of profit. And the rule at the top of the slide is the bridge between this unit and the last. Profit is income minus expenses, and profit directly increases owner's equity. First scenario, income earned on credit. The lodge hosts a conference for Thebe tours and bills them 45,000 rand. What happens? Debtors increase by 45,000 because Thebe Tours now owes the lodge that amount. So assets rise and income increases by 45,000, which increases owner's equity, plus debtors, plus income, both sides up balanced. Now read the margin note on the slide because it is one of the most heavily examined principles in the whole course. Income is recorded when it is earned, not when the cash is received. The conference has happened. The rooms were used. The catering was served. The staff worked. The lodge has done everything it undertook to do, so it has earned the 45,000 rand. Whether Thebe Tours pays tomorrow or in 6 days changes nothing about that. This is the accrual principle, and it is the reason accounting profits is not the same thing as cash in the bank. Second scenario, expenditure paid in cash. The lodge pays housekeeping wages of 18,000 rand. The bank balance falls by 18,000, so asset decrease, and an expense of 18,000 has been incurred, which decreases owner's equity, minus bank, minus expense. Both sides down by the same amount, still balanced. Notice how Group B differs from Group A. In Group B, money arrives from a funder and equity or liability rose to match. In Group B, the business traded and the result flooded or flowed into equity through income or expenses. Group A changes the size of the business. Group B changes how well it is doing. Group C, settling the score. And this is the group that catches people out. So work through it slowly with me. The scenario, Thebe Tours pays 25,000 rand toward the 45,000 rand account we raised a moment ago. What happens to the equation? The bank balance rises by 25,000, so asset increase, and the debtors fall by 25,000 because Thebe Tours no longer owes that portion. So assets also decrease. Both effects are on the left hand side and they are equal and opposite. Plus bank minus debtors. The net effect on asset is zero. And because nothing at all has happened on the right hand side, the net effect there is zero as well. The equation is unchanged. Now, the question student always ask at this point, surely the lodge is better off. 25,000 Rand has arrived in the bank. No. Here is why the lodge did not become better off today. It became better off on the day it hosted the conference, and we recorded that on the previous slide by increasing income and increasing equity by 45,000 Rand. Today, one asset has simply been exchanged for another. A promise to pay has been converted into actual cash. More liquid, certainly. More valuable? No. If we were to record income again now, we would be counting the same 45,000 Rand twice, and the lodge profit would be overstated by 25,000 Rand. That is what asset swapping means. And it is why Group C exists as a separate category. Cash movement and profit movement are not the same thing. Some transactions move cash without touching profit, as we have just seen. And some, like the conference billing, move profit without touching cash at all. The gap is not a technicality, it is the reason profitable businesses run out of money and fail. And it is the reason a hotel manager watches the data's figure as closely as the profit figure. 20,000 Rand of profit locked up in tour operator accounts pays nobody's wages at the end of the month. Checkpoint. Pause the recording here and work this out before I give you the answer. The scenario: the lodge receives a 7,000 Rand bill from etiquini municipality for water and electricity to be paid next month. Write out the exact mathematical effect on the equation and name the accounts affected. The trap in this question is the phrase to be paid next month. No cash has left the bank. Many students conclude that nothing should be recorded yet, and that conclusion is wrong. Here is the answer. Creditors increase by 7,000 Rand. The lodge has a present obligation to etiquini municipality arising from a past event. The water and electricity have already been consumed, so liabilities rise, and an expense of 7,000 Rand has been incurred, which decreases owner's equity by 7,000 Rand. So the effect is plus liability minus owner's equity. Assets do not move at all. Test the balance. The left hand side is unchanged, so it moves by zero. On the right, liabilities goes up 7,000 and equity goes down 7,000, and those cancel out. The right hand side also moves by zero. The equation holds. Notice what has actually happened in economic terms. The lodge is 7,000 Rand poorer than it was this morning, and it has not spent a cent. The electricity was consumed, so the cost has been incurred. And the fact that the payment is still to come does not change that. What has changed is who is funding the business. An outsider, the municipality, is now funding 7,000 Rand of it in place of the owner. That is the mirror image of the conference billing in Group B. There, income was earned before cash arrived. Here, an expense is incurred before cash leaves. Both are the accrue principle, running in opposite directions. Let us test the whole framework on a full set of numbers. This is the month one dashboard for the Mhlanga Guest Lodge. Start on the left, total asset, bank, 357,000 Rand. Equipment, 300,000. The vehicle, 250,000. The data, 20,000. Add those together, 357 plus 300 plus 250 plus 20, 927,000 Rand of total asset. Now, the right, owner's equity plus liability. Owner's equity is 547,000 Rand. That is Miss Naidu's 500,000 of capital plus 47,000 Rand of accumulated profit. The income the lodge has earned this month less the expenses it has incurred. Liabilities are 380,000 Rand. The 200,000 loan from Medfin plus 100 and 80,000 still owed to creditors. 547 plus 380 gives 970 and 27,000 Rand. 927,000 on the left, 927,000 on the right. The scales are perfectly balanced. And I want to be precise about what has just been demonstrated because it is easy to miss. Nobody arranged for those two totals to match. Nobody plagged a figure to force the agreement. The two sides were built independently. One from the resources the lodge controls, the other from the claims against it. And they agree because every single transaction during the month was recorded with a dual effect that preserved the equality. That is the self checking property of the system. If these two totals had not agreed, we would know with certainty that the transaction had been recorded incompletely, and we would go looking for it. In Learning Unit 4, the same check appears in a formal document called the trial balance. Now, the third movement of this session and a changing of language. Everything we have done so far has used plus and minus signs. That works perfectly well on a slide, and it is the right way to learn the logic. But no professional accounting system in the world records transactions with plus and minus signs. They use debit and credit. Why? Because plus and minus are ambiguous. A minus against a liability and a minus against an asset mean opposite things economically. One is the business owing less, the other is the business owning less. Debit and credit remove that ambiguity by fixing the meaning to a position rather than a sign. So look at the T account on the slide. Every account in the general ledger has this shape. The left side is the debit side, abbreviated DR. The right side is the credit side, abbreviated CR. Two things to get straight now before we go any further. First, debit means left and credit means right. This is all they mean. They are positional labels from the Latin for he owes and he trusts, and they have carried those names for 5 centuries. Debit does not mean increase, credit does not mean decrease, and neither one means good or bad. Second, and this is the confusion almost every student arrives with, forget how your bank uses these words. When your bank says it has credited your account, it means the balance went up. That is because the bank is describing the transaction from its own books, where your money is a liability the bank owes you. You are looking at the mirror. Set that usage aside entirely for this course. And here is the golden rule printed on the slide. Every transaction must have an equal and corresponding debit and credit entry, equal in amount, opposite in position. That single rule is what mechanically enforces the balance we have been demonstrating all session. Here are the rules. There are only two of them, and everything you record for the rest of the course follows from these. On the left of the slide, the debit balance accounts, assets, drawings, and expenses. For these, an increase is a debit and a decrease is a credit. On the right, the credit balance accounts, liabilities, capital, and income. For these, an increase is a credit and a decrease is a debit. Now, you could simply memorize those 6 words in 2 groups, and many students do. I would rather you I would rather you understand where they come from because a rule you understand survives exam pressure and a rule you memorize does not. Go back to the equation. Asset sits on the left hand side of A equals OE plus L. So assets increase on the left side of the ledger. That is a debit. Liabilities and capital sit on the right hand side of the equation. So they increase on the right side of the ledger. That is a credit. The ledger simply mirrors the equation's own geography. That accounts of 4 of the 6. Now, The other two, income increases owner's equity. Equity sit on the right. So anything that increases it behaves the same way. Income increases on the credit side. Expenses and drawings decrease owner's equity. They act inversely to equity. So they behave the opposite way. They increase on the debit side. So the whole system reduces to one sentence. Follow the equation's geography and remember that expenses and drawings run against equity rather than with it. There is one more consequence worth stating because every entry has a debit and a matching credit of equal amount. The total of all debits in the ledger must equal the total of all credit at every moment. That equality is what the trial balance tests in the next learning unit. And it is the same balance we proved arithmetically on the dashboard a few slides ago, expressed in ledger notation rather than in pluses and minuses. Say the two groups back to yourself now: assets, drawings, expenses increase on debit, liabilities, capital, income increase on credit. You will use them every day for the rest of this qualification. Final task. Let us read the matrix in the other direction. Everything so far has gone from a transaction to its debit and credit. Now I am going to give you the debits and credits and ask you what happened. An accountant records the following: debits, wages account, 2,000 rands. Credits, bank account, 2,000 rand. Translate that into its effect on the equation. Pause and answer if you would like to try it first. Work each line separately. The first line, debit wages, 2,000 rand. Wages are an expense. From the rule on the previous slide, expenses increase on the debit side. So, an expense of 2,000 rand has been incurred. Expenses decrease owner's equity. So, equity falls by 2,000 rand. The second line, credit bank, 2,000 rand. The bank is an asset. Asset increase on the debit side, which means they decrease on the credit side. So the bank balance has fallen by 2,000 rand. Asset decrease by 2,000 rand. Put them together. Asset down 2,000. Owner's equity down 2,000. Liabilities unchanged. Both sides of the equation fall by the same amount, and the equation balances perfectly. The universal law holds. And in plain language, the business paid wages of 2,000 rand from its bank account. You have just read a set of ledger entries and recovered the underlying event, which is, in essence, what an auditor does and what you will do every time you interpret a set of accounts. Let me leave you with the through line of this session. Every transaction has a dual effect. That dual effect keeps asset equal to owner's equity plus liabilities. Debit and credit are simply the professional notation for that dual effect, with debit meaning left and credit meaning right. In Learning Unit 4, we put this to work at scale. You will record transactions in journals, post them to the general ledger, and extract a trial balance. And when that trial balance agrees, it will be for exactly the reason you saw in the Humhlanga dashboard today. Thank you for your attention.